what a day. We have a lot of PMIs. There's a lot of concern about what kind of economy we'll be left with in Europe. How do you see the inflation complex changing as we get more and more data?
Well, first of all, as we say, we need really to look at the data as they come. I mean, we live in a very high uncertain times, and therefore it is not obvious really to understand all the trends. We have to look at them one by one carefully. So the PMIs in Germany is just a component of all the information that we get. We have been moving from very low inflation rates in the mid 2021 to the peak of close to 11% last September, October. And now we are going down to 7%, less than 7% in the headline. Everybody points out, yes, there is a substantial reduction, but it is all due to energy prices going down. There's been extreme volatility in energy prices, extreme. It went from 10, 20 euros per megawatt hour to 350, and now it's 40. So there is certainly a pass-through of the energy price increases to final prices that we have been observing up to now. And this is why core prices still show an inflation rate which is stubborn. The issue is there will be a pass-through also in reverse.
Yes, but this you laid out yesterday very clearly in saying, look, things are too uncertain to know exactly what needs to happen next. What does it mean for interest rates? Do we need to pause, take a breath, and look at what happens?
As I said many times, obviously, we have to be, I think, cautious. It does not mean that we stop, or it means that we decide meeting by meeting on the basis of the information that we get. What kind of information are we going to look at? This is very important because obviously we know everything that happens to energy prices in the markets, wholesale, but then there are two main factors that are relevant there: wages and profits. And this is what we are looking at, whether the wages will make up and whether profit margins will remain unchanged.
And Governor, I understand you're data dependent, and I understand that it has to be on a meeting by meeting basis, but you also have to take a view on whether there's more of a danger of doing too much or too little at this point. Do you worry about doing too much?
I am saying that there are two risks. If we do too little, then there might be a risk of having to do more in the future, yes, and being more costly, yeah, for the economy. If we do too much, well, we may overdo, especially now that there are some financial stability risks that we are understanding, not really relevant, directly relevant for the euro area, but contagion may be there and risks may be there. But especially if we do too much, there may be non-linear effects in the balance sheets. And we have a very clear indicator, that is what credit is doing now. And the rate of change of credit was very high in mid last year, and now it is, for business, negative. In real terms, in really negative territory. So this is an issue that we have to keep monitoring. So
could there be another banking crisis? Is that your worst case? I mean, if you look at the exogenous shocks and you talk about, yeah, systemic risks, what's the probability of that?
Well, no, in Europe, the banking sector, it is in, I'd say, good shape. There is good regulation, supervision is correct. Liquidity is there, profitability also, so the capital ratios are sufficiently high, but especially the business model of the two banks that failed in the last month are not in Europe. So this is, on the other hand, we have learned two lessons. The first is that there is confidence that may change very quickly. And the second is that news nowadays, through social media and others, really can change the picture from 1 hour to the next. So this is why you have to be vigilant and perhaps also be more informed than we are now.
But so does it mean, what does that mean for regulation? So more informed, do you worry about bank runs? And so do we need to look at how we do mobile banking? Or is actually the way that banks behave in lending to consumers?
Well, the bank run that you have seen in the States is very different from the bank runs we studied in textbooks. Last year they gave the Nobel Prize to those who looked at the bank runs, and from them came the deposit insurance schemes that have been very important up to now. They are not sufficient. We need to be ready to provide liquidity if a bank is solvent, but we have to understand, we have to monitor them very, very much. And if we provide liquidity, then in time, then I think this is also a message that the market understands. So there must be more interaction, certainly because of the times that are changing.
But given all this, do you actually worry about a credit crunch? And if yes, then it would also point to being much more cautious on interest rate hikes.
We do not have a credit crunch situation now, but we have a reduction in credit, certainly for the business sector, and a substantial slowdown for households. And this has taken place in a matter of months. So since monetary policy has effects in over time, it is not immediate. Milton Friedman was talking about long and variable lags. And so long lags means that we have still to see all the effects of our monetary policy measures. This is why I'm saying that I don't exclude rising rates or whatever, but I think we have to be prudent, cautious, and patient.
Do you think some people on the ECB Governing Council just want to go too quickly?
Well, I'm not prepared to discuss what they may say in next week, because it is going to be discussed next week. I think that we have been very quick. There have been some criticism for the ECB responding a little bit too late. That's not true. First of all, inflation was still very subdued mid-2021. The increase in energy prices that took place in the fall, winter, was there, but it was not really very strong only after the Russian aggression to Ukraine. What we did already to announce at the end of 2021, our policy, and markets discounted it. So it has been. And then we have been moving rates of 350 basis points in a matter of 8 months. Yeah. So really substantial.
And this, I guess, is the key question. How much does it take to see it in the real economy? So I know you mentioned Milton Friedman, but are we talking 12 months or 18 months?
There are many estimates. They're all based on historical regularities. Somehow, rule of thumb says 18 months. This is more or less 1 year, 1 year and a half. This is more or less what it may be quicker. It may be quicker, especially now that we have seen the energy prices going down directly. The point is, will there be another shock? Do we have uncertainty reducing in the next months? I don't think so. I think that the geopolitical situation is very tense, and we have to be prepared. So, in this sense, I understand also the wait-and-see attitude of those who say, no, wait for a while before reducing the tightness.
But when you talk about geopolitics being maybe your number one worry, is this the interplay with China and Taiwan, or is it the more immediate invasion of Ukraine?
Well, I'm not a military expert, and I don't know what's going to happen there. I'm very worried about a return to a world divided in blocks. I think it would be very dangerous, not only for our societies and economies, but really for the ability that we have to maintain a sufficient rate of expansion, of growth, of development. And so that is an issue. On the other hand, it is clear that in order to solve these problems, economics or finance is not enough. You need diplomacy, you need politics, you need smart politicians.
Governor, I don't know how you would describe the relationship between central banks and the markets in the last 12 months. I don't know whether you describe it as difficult or mismatched. Well,
first of all, there is now some people who say that there is financial dominance. There used to be fiscal dominance because the central bank is not going to sell the bonds it has because it has fears that the debts might have problems, and now we have financial stability. I don't think that this is a relevant issue. I think that and markets actually, for the time being, are discounting well our actions. If you take as a single indicator inflation expectations from index-linked swaps, 10 years from now, you see they are flat at 2%. So the credibility there is still very, very strong. And I think it's wrong to say markets do not understand what we're doing, and it is at the same time wrong from the market saying, well, the central banks are a little bit confusing us.
We also had a pretty important speech about central bank independence that Christine Lagarde was talking. Do you think it's something that will come when we have all this complex geopolitical situation, the decision to either crush an economy if inflation stays high? Do you think that will be one of the dominant themes for central banks?
This is an important question, and I have to say that we have seen monetary policy the only game in town for too long. Even to combat inflation, central banks should not be left alone. You need the cooperation from the fiscal side, and you need also the business sector and the unions really understanding what is that they have to do in order to absorb what has been a shock from outside, a tax. Say it used to be a shake tax in the 1970s. Now we have this different tax. You have to absorb, take it, and perhaps protect those who are hit, but at the same time increase your real incomes through changes in productivity, investment, and so on. This is what the firms have to do.